Hey folks, I want to talk about this concept, not real difficult, in regards of purchase commitments. Okay, now, purchase commitments. Well, to preface this, in past accounting classes, we have learned that the buyer does not have to record the inventory that they purchased, nor the liability, until they've either received the asset or if they're paying for transportation until that asset is being transported. And, this is due to the fact that usually those agreements they're subject to cancellation. But what do we do about this idea of purchase commitments? Well, first of all, what is a purchase commitment? Okay, it's an agreement between a buyer and a seller that the buyer will pay, or the buyer will purchase a certain amount of inventory at a certain period of time in the future at a specified price. Okay, so it's just what it says. It is a commitment to purchase a specific type of inventory at a specific time at a specified price. Okay? Now, in most cases, the buyer does not have to make any journal entries. Okay? Even if the purchase agreement is a formal, non-cancelable purchase contract. Okay? And if you want to get into the legal reasons, it's because the agreement is executory in nature and neither party has done what they're supposed to do per the contract. Okay. Now, if the purchase commitment is material, they may need to discuss it in the notes to the financial statements. Okay, even though that we didn't book a journal entry in regards to a purchase commitment. Okay. Now, with the discussion above, however, we are assuming that the contract price, the price that we agreed to make the purchase at, is not significantly above the market price of the balance sheet date. Okay, so these two things up here, that's all good and fine, but we are assuming in that case that the contract price is not significantly greater than the market price. Okay, well, what if it is? What about the unique case where the contract price, the price that's stated in the purchase commitment, is significantly and materially above the market price? Okay, what do we do in that unique case when the contract price, the price that we've agreed to in that purchase commitment, is significantly above the market price? In that case, the buyer does need to make a journal entry to record that unrealized loss. Okay, now I think an example is going to be helpful here. Again, not too complicated, but let's take a look. All right. Okay. Josie Company signed a long-term, non-cancelable purchase commitment with a supplier to purchase some specific items in 2016 at a cost of $450,000. That is the contract price. Now, at December 31, 2015, that purchase we've agreed to make in the future has not happened. Those specific items to be purchased, they have a market value of only $410,000. Okay, so that is materially and significantly less than that purchase price. Prepare any December 31, 2015 journal entry that's necessary. Okay, let me go ahead and write out the entry that is needed, and I'll bring you back in here in just a second. Okay, this is the journal entry that we would make. Now, the difference between what our contract price of $450,000 is versus the market value at December 31 of 15, the journal entry date, is $40,000. So the journal entry that we have to make on 12/31/15 is this. We are going to debit unrealized holding loss, and this would go on the income statement. Okay, like all losses, it would be subtracted in arriving at net income, but it is an unrealized holding loss because it has not been validated yet by an actual transaction. Okay, that's what unrealized means. So we would debit that loss for $40,000 and we would credit this estimated liability on the purchase commitment for $40,000. And that's a liability just like any other liabilities. Okay? Now, let's continue this discussion. In 2016, Josie Company, we ended up paying $450,000, which is our contract price, to purchase those specific items that were worth $410,000 in the market. What is the journal entry that we would make to record that purchase? Okay, what we would do here, first of all, we would debit inventory. Now we would debit inventory if we're using the perpetual system. If we were using the periodic method of inventory, we would debit purchases. But let's say we're using the perpetual system. We would debit inventory for $410,000. Okay. Now we paid out cash of $450,000. That was what our purchase commitment specified contract price was. Okay, so what do we do with the difference here? Well, we debit this estimated liability on purchase commitment that we credited up here. Now we're going to debit it. Okay. Now the reason we do it this way is this. If we just credited cash for $450,000 and debited inventory for $450,000, that really would be kind of overstating the inventory. Yes, we were unlucky enough in this instance to have a purchase commitment where we had to pay $450,000 for something that really is only worth $410,000. Okay? So that kind of stinks, but if we recorded that inventory at $450,000, do you see how that would be overstating our inventory a little bit to the external readers? So this is more like saying, okay, yeah, you paid $450,000, but you're only going to be able to value that asset at $410,000. Okay, this kind of brings some of those aspects of lower of cost or market into play. Okay, so purchase commitment's not a real difficult concept, but I did want to make a video for you in regards to it. Thanks.